Hey everybody, hope everyone's doing well. Had a good day. This is the Emini end of day review for Monday, August 12th, 2024. Coming into the day, it's Monday. So looking at the weekly chart first. Tight bull channel, trend line break. Now we have 4 consecutive bars with lower highs, lower lows. This is a micro channel for the bears. And it's a pretty decent trend line break. As far as buying above this bull bar, it's not ideal. It's following 3 consecutive bear bars. It has a very small body. And the rallies before this buy setup might have been climactic. We might have 3 pushes up here, and then in here, 1, 2, 3. So consecutive buy climaxes, then a pretty steep bear breakout. I think more likely there are sellers above this week. However, it's a bull bar closing on its high. The sellers may not come in directly above the bar, but some places the sellers may come in. Here's a 50% pullback of this bear breakout, and then maybe this looks like a trading range, big up, big down. So you would expect this bull breakout to fail, not reach this measured move target. Maybe we rally halfway to the target, somewhere in here, but then find sellers. But I do think more likely if we do rally after this trendline break, there's going to be bulls who bought up here, disappointed, looking to exit longs. You had bears who did not sell. This is a leg 1 breakout, so probably sellers above and a second leg down. But this is the weekly chart, so this could take some time to unfold. And then for the daily chart coming into the day, this is the extended hours chart. And you can see coming into the day, consecutive sell climaxes, sideways, bull breakout attempt, outside up, but then a small follow-through bar. And the context is not very good for the bears, or for the bulls rather. The bears just had this steep 3-bar breakout. Now we're going sideways to up. I think more likely this is a pullback, and there will be at least another leg down. Bull breakout bar, but overall 4 bars sideways, and then you get a bad follow-through bar. Probably sellers above at this breakout point, at the moving average, maybe the 5,400, big round number. So I thought the odds were there would be sellers above yesterday's high, which in this case is Friday's high. If I ever mention yesterday on a Monday, I'm referring to the last trading day. So in this case, if I talk about these blue lines as yesterday's high and yesterday's low, I'm actually talking about Friday. And then just one more thing. I wanted to look at the Globex chart coming into the day. And here's the open of the day session. So here's what we have in the Globex session coming into the day. You can call it a bull channel, that's true. But we do have this resistance area to the left. You can see over where the market currently is coming into the day. The bulls are failing to break out. So this might all be a trading range. To me, these bull legs look like a leg in a trading range, less than a bull trend, even though the market's getting higher lows, higher highs. You can draw a channel like that But one of the problems that I have with the bull channel is that gaps are closing. So here we broke out above this bear bar, but then closed below the open. Same thing happened here. We broke out over here above this area, but then closed below. And then again here. Broke out, but then immediately closed below. And then even right here, broke out and closed below. So gaps are closing, and that's characteristic of a trading range, or a leg in a trading range, less than a leg in a trend. So coming into the day, we know we have a lot of trading range price action in the Globex session, and it's no different than what we have from Friday's close. Look how tight this trading range is, and even with the gap up and a bull bar on the open, just look to the left. So we have a gap up, which you can see as a breakout, bull breakout, and a follow-through bar. There's a bull bar, but it's a doji, so minimum follow-through, and the breakout is not breaking out of the trading range. You look to the left, we're still within yesterday's high. Most bars are breakout bars. Most bars go above or below the prior bar. If you look at any chart, most bars are not inside bars. So inside bars are the only non-breakout bars. So you can see, just look at any bar on the chart. This bear bar went above the high of the bull bar. This bear bar broke out below the low of the bear bar. We have an inside bar here, but then we broke out above both sides, broke out below. The point is, most bars are breakout bars. And that's true for all charts because markets are fractal. It doesn't matter what time frame you're looking at. And so with that information, we're opening up here, only a couple of points away from yesterday's high, and yesterday's low, or Friday's low, is all the way down here. So the odds are we're going to break out of either the prior day's high or the prior day's low, and in this case, we're so close to the high that it will probably be the high. So bull breakout, it's a gap on the open. Minimum follow-through bar, but there's not enough evidence that there's a bull breakout or a successful bull breakout at this point. When you think about leg count and the market cycle, you ask yourself, what leg is this? One problem for the bulls is that this could be leg 3, and it's probably more clear on a 15-minute chart, but in any case, maybe leg 1, leg 2 or 2, pull back, and then leg 3, breaking out of a bull channel. Bull channel, bear flag, here's a bear breakout. This might be a deep pullback and a double top. There might be sellers in this area. So at this point, I need more evidence from the bulls that they are strong. If it's going to be a bull trend day, there's going to be plenty of time to enter and to buy later. But I need to see strong bars closing above yesterday's high, and we're just not doing that yet. And then bar 2 was very strong bear trend bar. A little bit surprising. You probably have disappointed bulls who bought over here, exiting their longs. You have bears betting bear breakout, and then bear flag, double top, bear flag, maybe a major trend reversal. We have a bull trend, trend line break, retest, bears will sell. So a good looking bear bar, but it's completely above the moving average. The bears still need follow through. Even if they get follow through, if it's not well below this trading range, then this could just be a sell vacuum test of support of some price in this trading range. So there's a lot of two-sided trading here. We saw the Globex session. There's a lot of two-sided trading in there. So we need to be careful with breakouts, because breakout bars, trend bars in trading ranges typically lead to profit taking and then reversals. Look over here. Here's a trading range, bull bar, and then bad follow through. Bull bar, bad follow through. Bull bar, bad follow through. This is the third leg up. So we can pull back more deep. Over here, it's the same. 1, 2, 3. We can come back and test maybe the bar 78 low, maybe test the bottom of the third biclimax. That's one target. The bears want to see what's down here, the bottom of the range. We know it's a trading range. We just don't know if maybe this is the bottom, or all the way down here is the bottom. And then good follow through on bar 3. So consecutive bear bars, both really being big and closing near their lows, crossing the moving average. It's good for the bears. However, the context still isn't great. Because bar 3 is still closing within this trading range, it could easily be a sell vacuum test of support, and we could reverse up just as quickly as we're falling. We saw it over here. Good bear bars, but reversed up strongly. Good bull bars, but then reversed all the way down. Even here, we've had a lot of two-sided trading, and the odds of this leading to a bear trend are not yet very high. The bears need to get closes below this trading range at a minimum, and even still, like I mentioned earlier, even closes down here, we're still within this overall trading range. Bar 4, a third consecutive bear bar. Good for the bears, probably strong enough for a second leg down. However, 50% of breakouts on the open will fail no matter how strong they look, and then lead to a test of the opposite side. Running the bear stops, the theoretical bear stops up here, there's an increased chance that this breakout will fail when we know the context on the overnight session, the Globex. We know it's a trading range. So the context for a bear breakout here is not very good. We also might be testing 50% of Friday's range. So here's Friday's range. There's a magnet, the midpoint of the bar, and then there's this trading range low. We're testing both of those areas on bar 4. And so that's an event. We have a bear breakout testing possible support. Now we need to see if the support will hold or if the bears will break through it, and then it will turn into resistance. Why is the 50% pullback of yesterday's range important? Because we had a bull trend bar, or you can call it a bull reversal bar, but either way, it's a bull bar, and you will have bulls buying a pullback, buying 50% of the bar. So again, this could be a sell vacuum test of support, and it's on the open, so decreased probability for breakouts. And then we had an inside bar on bar 5. It's a low one sell signal bar, but it has a bull body, and it's at the bottom of a trading range. There's probably buyers below 5, but any pullback will likely lead to a second leg down. This was strong enough to trap traders. And then 6, we sold off to a new swing low. We fell below the low of bar 4, but then there were buyers into the close of the bar. So now we have a micro double bottom with bar 4, bar 6. Bar 6, not a very strong buy reversal bar, but the bar did close around its midpoint, and it's not ideal for the bears. Some traders will view that as a second leg down, so leg 1, pull back, leg 2. Others will say this is all leg 1, we'll get maybe a deeper pullback, and then a more symmetrical leg 2. But if this were to reverse, we had a trading range or a bull trend, then traders would look back and say the bears did get their second leg. So this is kind of the minimum second leg for the bears. And then 7 was a bull trend bar closing near its high. So now we have a good signal bar for the micro double bottom, possible opening reversal. Also, this could be a second leg trap with over here. Leg 1, complex pullback. Leg 2. Leg 2 being stronger, or at least appearing stronger, but climactic and racing down to support. And then when it gets there, it goes sideways. So this is disappointing follow through for the bears. They had one bar break below this trading range, but then no follow through. And same here. But now bar 6 didn't even close below the low of bar 4. So again, this is disappointing for the bears. On some time frame, even though technically on this chart, bar 6, bar 7 going above bar 6 was a high 1. This is an implied high 2. I said it's a micro double bottom. Every double bottom is a high 2. So high 1 somewhere between these bars, 4 and 5, and then high 2 here. So whenever the market is in a trading range, you get a high 2 at the bottom of the range, like we have here, bears will typically exit, look to sell higher, and bulls can buy for at least a scalp. If the trading range is broad, then maybe bulls can buy for a swing. And then bar 8, strong bull trend bar, probably flipped to always in long, but we're in a trading range, so whenever it's always in long, the upside might be limited. We could easily just come up and test maybe the bar 1 low or yesterday's high. Maybe we'll get up to 5,400. Hard to say at this point. We're not very close to there yet. But the point is, consecutive bull bars, one being big, both closing on their highs. Good for the bulls, but big down, big up. It could lead to a buy vacuum test of resistance, and this bull breakout could reverse the same way this bear breakout is reversing. But for now, there's room to the upside. This looks like a trading range, and as I mentioned in the beginning of the video, on the Globex chart, when the market's in a trading range, gaps close, and right now there's an open gap from the bar 1 low to the current market price. So at a minimum, we'll probably test here. 9, another bull trend bar closing on its high, but much smaller than bar 8. So the bull body's now getting smaller as we approach what could be the top of the range. Still probably going higher. Bars 7 through 9 strong enough for a second leg up. Probably buyers below bar 9. Bar 9 is a weak sell signal bar. It's a bull trend bar. It's also, maybe the bears will call it a lower high, double top. But again, the momentum strong enough that we'll probably go at least a little higher. Buyers below the first reversal attempt. And then bar 10 reached the low of bar 1. You can see we went sideways. The market rallied to that price and then sold off. We're pausing here on bar 10. But again, we'll probably go at least a little bit higher, maybe buyers below 10 for a brief second leg. But overall, you look to the left, the market's in a trading range. Big up, big down, big up, big down, big up. So buy low, sell high should be in the front of your mind. And then bar 11, another bull trend bar. So the micro channel continues. Now we have 6 consecutive bars in the bull micro channel. We're testing the prior high of the day, the bar 1 high. It looks like we did not quite get above it. The odds are we will get above it, so we will go at least a little bit higher. So there's a little bit of logic for high frequency trading firms to buy the close of 11, betting that the momentum is strong enough, we'll go at least a little bit higher. The odds are 80% of the time bar 1 does not remain the high or the low of the day. And when it does, generally the day is a trend day. We know at this point in the day, big down, big up, it's probably going to be a trading range day. We're also this close to the high. So some bulls will buy the close of bar 11 and just look for a new high. You also have the stat where most bars are breakout bars, so traders will still keep buying the close, buy below bars, betting that we'll get above the prior day's high. And then 12 rallied to above Friday's high and then reversed back down. 12 is a doji. It's a weak signal bar for a short. Context, it's good for the bears, the fact that we're high in a trading range, but if you look to the left, 7 bar bull micro channel, a doji signal bar, not very good selling pressure on the way up, probably buyers below 12. The bears probably need at least a micro double top, some sort of second reversal. Inside bar 13. Inside bars are trading range bars. Most of the time they are triangles on a smaller time frame chart, and they can be good signals. They can lead to good setups depending on the context. Like if you are expecting a reversal or a trend resumption. So in this case, we might be expecting a reversal back down. Bull leg in a trading range, bear leg up and down, back up. The odds are the breakout will fail. And the bulls might try a couple of times here. We've already tried once above the prior day's high and then immediately pulled back. We may try again. We may try several times. And that's where it's our job to watch the price action and watch what's unfolding and look to react accordingly. So we have an inside bar on 13. Some bears will sell below it, and they'll bet, well, not a very good sell signal bar. It's a bull inside bar. It's a trend bar, but we're at the top of this trading range, so the risk might be small. The reward could be big. For the bulls, it's still a tight bull channel, and this could break out into a bull trend. So some bulls will buy above 13, seeing it as a bull flag. 14, breakout to the upside, but not a very strong or big bar. There's a tail on top, and the bar is probably less than average size. But again, the micro channel is continuing, so we probably have buyers below the bar. It's a weak signal bar for stop order bears. 15, we have a bear reversal bar. So 14 broke out above Friday's high. The bulls still need follow through, and they did not get it. That's 2 attempts for the bulls. They tried on 12, they failed. They tried on 14, they failed. So 15, even though it's following a micro channel, is actually a more reliable sell than below bar 12. Now the bulls have had 2 attempts to break out. 15 is a good signal bar. And on some time frame, here, bar 9, we rallied, paused. 11, we rallied, paused. And then 13, we rallied, and then reversed on 15. So it's a wedge on a smaller time frame chart at the top of an overall trading range. So some bears will sell below 15. They'll use a wide stop, maybe a measured move of the signal bar. Maybe they'll put their stop 1 times the bar. Maybe they'll put it 2 times the bar above, and they'll use a wide stop, scale in higher, expecting a reversal back down. We triggered the sell on 16 and then reversed up. It's almost a bull outside bar. It actually is an outside bar, even though 16 did not trade above the high of bar 15. It's an outside bar variant. It's close enough. It went below the prior bar's low, and its high is equal to the prior bar's high, so it functions exactly the same as an outside bar. So at this point we have an outside bar, but we might be late in a rally. It's also a breakout attempt of a double top. So here's the double top with bar 49 on Friday, bar 1 today, double top, bull breakout attempt. But any failed breakout attempt of a double top becomes a wedge top. Even though it doesn't look like a wedge, even though this push is below this one, it functions the same way. 16 being an outside bar, it's an expanding triangle on a smaller time frame. We know the bulls just had 3 consecutive buy climaxes, now maybe 4. And the bulls are unable to get decent consecutive bull bars. They got them down here on 8 and 9, but again, 9 was a lot smaller than 8, and it was well within the trading range. And then up here, bull bar, doji, bull bar, smaller bar, and then a bear bar. So the bulls really need follow through here. And then they did not get it on 17. Inside bar on 17. Now we have an IOI pattern. 15 is inside 16, which is outside 17. And again, it's just a breakout mode pattern. And when you're expecting a reversal or a trend continuation, it can be a decent setup. So here, even though the inside bar, 17, closed above its midpoint, it does have a bear body. And again, it's possible we get a reversal back down because just look to the left. Big up, big down, big up, big down, big up. Markets have inertia, and 80% of breakout attempts of trading range will fail. So bears will sell below 17, use a wide stop, scale in higher. Bears hoping it's a relentless small pullback trend that continues. However, unlikely with the selling pressure on the open. The odds are today is a trading range day. Big down, big up. Probably not a trend day in either direction. 18, a bull breakout bar. It's a reversal bar. It's trying to break out to a new high of the day, but this is a channel. And when the market's channeling, bulls take profits above bars, they buy below bars, and bears will sell above bars for at least for scalps. So at this point, you could say bars maybe 7 through 9 is a bull breakout. It's a spike. We paused on 10. That's the start of the channel phase. It's a pullback. We've been channeling up. This is a tight channel, but look to the left. I keep saying look to the left because that's the context. And whenever there's big up, big down, you know the market's in a trading range. So no matter how strong a bull trend looks or a bull breakout looks, the odds are it will fail. I actually have a good example of that. Give me 2 seconds to pull it up. So the chart that I'm pulling up it's an example of the importance of context. I don't really have writing on this slide. It's really incomplete, but the example is here and I can talk through it briefly. Just take a look at this bull breakout where my cursor is. We have 1, 2, 3, 4, 5 consecutive bull bars. They're uniform in size. There's micro gaps. There's very little overlap. As soon as one bar closes, the next one opens, barely pulls back before rallying. Same thing here. Rallies right away, closes, the next one opens, rallies right away. Bull bars closing on their highs, crossing the moving average. This breakout has a lot going for it. However, the most important thing on the chart is context. So just look to the left. Very tight trading range, consecutive buy climaxes, maybe a wedge top, then a very deep pullback. So this rally is following trading range price action. Maybe it's an expanding triangle, 1, 2, 3, maybe 1, 2, 3. I'm not sure if this low is below that low. Maybe not, but either way, we're getting tests down, tests up, up and down. So the context really ruins this bull breakout as strong as it looks, and it's still okay to buy and take a chance. It's a strong enough breakout for a second leg. You can buy anywhere, maybe go for a measured move. But once you start going sideways, at some point, this is very disappointing. You start getting more bear closes than bull closes. This ends up being an endless pullback. And then eventually, you can see we got a bear breakout of the bull flag. We're at the top of a trading range. This is the give up bar. This is bulls giving up on the longs. And the market's falling back to test the bottom of the trading range. So as decent as this rally looks, when you look to the left, you have to wonder if it's a buy vacuum test of resistance in a trading range. Especially up here when you're not getting consecutive bull bars, you're getting bull bars, pullback, bull bar, pause, bull bar, might be 3 pushes. Bull breakout on 19, the channel is continuing, but it's now accelerating on 19. 19 is a bigger bar than 18. Might be climactic, might be 3 pushes up. So here might be a bar where bulls look to take profits. Aggressive bears can sell, betting it's 3 pushes up and a failed breakout. of the prior day's high. And then an inside bear bar on 20. Disappointing bar for the bulls. 18 was not breaking out. 19 did break out, but now you need follow through, and then you don't get it on 20. At some point, right now, the market, you could say, is always in long, but you get a bear bar like 20, you have to get out of longs below bar 20. I thought it was even reasonable to exit below 15, even though it's a micro channel, you probably get a second leg. Well, this could be the second leg. We rallied, we finally pulled back on bar 16, and then we rallied for one pause, two more legs. Now we have an inside bear bar closing on its low. Bulls will exit below that bar, bears will sell using a wide stop, scaling in higher. And then 21, mostly sideways, we broke out above 20, but then reversed down. On some smaller time frame, we have a bull trend, a couple of legs up, a trend line break on 20, and then 21 retested the bull trend's extreme. Did not quite get to the high, but it did test the high close. So bulls who bought the close of 19, disappointed on 20, had a chance to exit at break even on 21. Now we have a micro double top and consecutive bars without a bull body. More bulls may give up below 21, and bears will sell. Betting will at least pull back to Friday's high, maybe the moving average, and overall this could be a trading range. 22, it's a weak entry bar for the bears. It's only a doji, now consecutive doji bars. But think about the flip side for the bulls. We have a high one above bar 22. But a lot of trading range price action for the past 5 bars. We may have to pull back deeper. Might be a bull trap above 22. There might actually be more sellers above 22. And then we pull back, maybe get a high 2. And then 23, obviously a little bit of a surprise. It's the bull give up bar. So the bulls who were long, eventually the momentum is fading. It's a bad buy setup. High one with 3 consecutive bear bars. And the context isn't great. You're probably high in a trading range. And then all of a sudden the bulls exit their longs and the bears sell. And after you get a bar like 23, you are expecting a second leg down. But 23 is a classic example of an emotional breakout bar where the context really isn't great. It's a huge bar, it's a good looking bar, but remember what I said about context. No matter how strong the breakout looks, context always trumps everything. So at this point, you're actually in the lower third of a trading range. This can be a sell vacuum test of support. We might be testing the bad signal bar, bar 6 high. You can see that's actually exactly where the market is testing. So there's an increased risk that we bounce here. Huge bear bar. Bears who sold above will take profits. Climactic bars typically lead to 1 to 3 bars of sideways price action. And you add that to the fact that traders who bought above, or traders who sold above 6, betting it's a weak signal bar, and bulls who did not buy above 6 for the same reason got trapped. Bears got trapped in, bulls got trapped out on the rally. Now we're retesting it. We'll probably at least bounce there. And here's the thirds of the trading range. The upper third, the middle third, the lower third. So now we're suddenly back in the buy zone. So the bear bar might convince you it's always in short, but the context is bad. It's more trading range price action. So think buy low, sell high. And at this point, we are low. Disappointing follow through for the bears. They did not get follow through. 24 is a good looking bull trend bar, but probably not enough to reverse 23. 23 is still probably going to get a second leg down. Maybe we'll test this red line, the low of prior day's trading range, or some other support below. Also, you can see we came close to 5,400, but the bulls just could not get consecutive breakout bars with follow through. And then eventually we had this huge sell off, probably not going to 5,400 today. So 24, it's a good looking bull bar. What about double bottom with 6, 24? Can you buy above 24? I don't think so. I think it's similar to selling below 15, where you can, however, you're buying above 24. It's like I just showed with the thirds of the trading range, where you want to buy low, sell high, and really do nothing in the middle. So if you're buying above 24, you're forced to buy in the middle third of the range, so not ideal. So bulls would prefer to buy below 24, probably more buyers below 24. Bears might sell the close of 24, betting that it will not reverse 23, and they can sell at a discount before there's a brief second leg down. Disappointing bar for the bulls. Really disappointing follow through for the bears as well, 24 and 25. 25 is an inside bar. It's a reversal bar closing above its midpoint. Weak signal bar for the bulls, so still probably going lower, but buyers below 24 scaling in lower. Bears, they might sell above 25 and scale in higher for a second leg, but increased risk that we're in the lower third of the trading range and the bears could easily get overwhelmed by the bulls. 26 more sideways. This is a triangle on a smaller time frame chart, really just breakout mode. We've had 3 bars sideways after the sell climax. This is disappointing follow through for the bears, so we may get a brief second leg and then a give up bar. The bears give up, they take profits, the bulls start buying aggressively, and then we go back up and test the top of the trading range. 27 outside up. So now we've had, let's look back at the close of 23. If a bear sold the close of 23, they're betting the momentum down is strong, will probably fall for a measured move, which really isn't correct. We probably will not fall for a measured move, despite the strength of the bar, as strong as it looks. The problem is risk reward. What are the odds we get down here before we're back up here? It's not 60%. With the momentum at the time, maybe it's 55%. But then what about now, after seeing 24? Probably even less. So if a bear sold a close of 23, 24 is their entry bar, they're disappointed. You can see what happened on 25. We came very close to the close of 23 and then rallied, and then we haven't come back down to that price since then. So if a bear did not take that brief opportunity to exit near break even, if they had a limit order to buy back their shorts at the close of 23, they have not been filled for now 4 consecutive bars. And so what we might be getting on a smaller time frame chart is it's an endless pullback. Bear breakout, this is a bear flag, bull channel, but increased risk that we're low in a trading range, and we get the bull breakout. 27 is an outside bar, so we tried to go below 26, but then reversed up and closed near the high. The bears will say it's 2 legs up and a pullback, 24, pause, and then up to 27, expanding triangle. They'll sell above 27, looking for a second leg down. But again, remember, this is the middle third of a trading range. Not ideal to do anything here. And then a good bull bar, 28, closing on its high. So if a bear did sell above 27, expecting a low 2, and then 28 is their entry bar, they'll probably give up and look to sell higher. Not an ideal entry bar. Their premise is no longer valid. And the bulls start to see the buying pressure. In the past 5 bars, we've had 4 bull bars, and this is bad follow through for the bears. Like I said, it might be an endless pullback. This might be the start of the bears giving up. And then it looks like the bears are giving up on 29. So we're getting a buy vacuum on 29. But think about breakouts all day today. As strong as this bull breakout looks, bull bars and bodies getting bigger, very little overlap. Consecutive bull bars closing on their highs, one being big. we're racing up to the upper third of a trading range. We're racing to an area where bulls got trapped earlier. 22 was not a particularly strong sell signal bar, but we still got this huge sell-off. So traders got trapped here. This red line, the low of 22, is expected to act as resistance. Plus, we just rejected the breakout above yesterday's high with a lot of strength on 23. So the odds are we're not going far above yesterday's high again. 30, another bull trend bar. We're getting right back to the low of bar 22. It's again a good looking bull bar, but think about the example I showed. You can go back and look at the PowerPoint slide that I showed. Good looking bull breakout, but look to the left. We're still within this trading range. We're high in the range. We're testing a breakout point. Big up, big down, big up. At this point, the bears might see it as a head and shoulders top. Maybe left shoulder, head, right shoulder. As strong as the breakout looks, just look at the breakout on the open. Decent looking bear breakout, but reversed up. Decent looking bull breakout, reversed down. Back and forth all day. These are just sell and buy vacuums of support and resistance. So as soon as the market convinces you it's always in long, you get consecutive bull bars, you're getting follow through to buy the closed rally. As soon as it convinces you of that, it's usually time to take profits on longs and actually look to sell. 31, a bear reversal bar, lower high, you can call it a double top. But after consecutive bull bars, the first reversal down will likely fail. The bulls will probably get a second leg to the upside, but it could be limited. We might be high in a trading range here. So maybe not an ideal sell below 31, but bears will sell below 31 and scale in higher. They'll also sell above the bar. They'll sell the new high. 32 broke out below 31 and pulled back immediately. The bears see a breakout, pull back, and they might sell the close of 32. Betting will test back down lower. Also, 32 is a high one signal bar. After the rally, high in a trading range, consecutive bear bars, it's a bad signal bar, bad setup, probably sellers above, scaling in higher. But the bulls still might get a brief second leg. Maybe we'll test the prior high. Inside bar, 33. So it's kind of similar to what happened down here, where the bears had this bar, maybe they sold the close, got trapped, endless pullback, and then we rallied. Then on this rally, bulls by the close of 30, disappointed. They're having no chance to exit at break even. So they might eventually just give up without getting the chance. We still might get a brief second leg. Maybe we rally above 33, test the close of 30, and then reverse down. But you do know that we have trapped bulls above, and they know that they might be long at the top of the trading range. We could come all the way back down here. 34, another bear bar, a 4-bar micro channel for the bears. Not very strong, maybe 2 legs down. We sold off on 32, pulled back and went sideways, and then sold off again. So 1, pull back, 2. Might be a high 2 bull flag, bull trend, 2-legged pullback, and then maybe a second leg up, but still a bad signal bar. More likely sellers above for at least a brief second leg down for the bears. But they may not come in until a little bit higher, like maybe the 30 close. And then a micro double bottom on 35, and it's nested. So we sold off on 32, and then reversed, and then we went down, and then up. And then on just these 2 bars, we went down, we went up, we went down, we went up. So micro double bottom, it's nested. It might be even a wedge bull flag, 1, 2, 3. So we might be in an area of support. And just one more thing. It looks like we're well above the 50%. So here's 50%. We didn't quite get down to it. But in any case, this might be support. We may rally for a second leg for the bulls. But the bulls and bears are expecting breakouts to fail. Here's a bull breakout, and then the bulls took profits. The bears start selling. They may get a second leg, but the odds of going for a measured move of this bull breakout, very unlikely. 36 a bear. It's really a doji, 4 consecutive or even 5 consecutive trading range bars. Bad. Signal bar, it's a nested, well, I called it a wedge. Bull flag, I can call it a high 1. It's technically the first bar to trade above the high of the prior bar since the pullback, or you can even call it 1, 2. So this could be a high 1, a high 2, or a high 3, depending on how you look at it. If you haven't studied Al or his bar counting, what I just said probably sounds really confusing. How can it be a high 1, a high 2, and a high 3? I might make a video on that at a later time and clarify what I'm talking about. But for now, all the answers to that are in the books and in the trading course. But in any case, it doesn't matter what you call it. It's a bull flag, but it's high in a trading range. Probably sellers above. You're expecting a brief second leg, if that. 1, 2, and then a reversal down. 37 traded above 36 and then reversed back down, almost outside down. Now you can call it 2 or 3 legs like this, 1, 2, 3, or just simply 1, 2. We have a lot of bars sideways here, so this is a trading range on a smaller time frame. So the close of 37 is low in that tight trading range. The odds are there's buyers below the bar for at least a scalp. 38, we tried to break out of the tight trading range, reversed back up. Good looking bull bar, but still within the tight trading range. So no matter how strong the signal bar looks, context will trump it. So maybe a high 2, high 3 above 38, bull flag, but high in a trading range, expecting sellers above. May go a little bit higher. Maybe test yesterday's high, Friday's high, but not an ideal buy if you're looking for a swing. This does not look like a bull trend. This looks like an overall trading range. 39 broke out above 38, but immediately failed. We're continuing to go sideways in this tight trading range. Probably sellers above, buyers below. 40 rallied again, but pulled back. So maybe 2 legs up, 1, pull back, 2. High in a trading range. Remember, this was a micro channel, and now we're getting maybe a complex pullback, 2-legged pullback. So for the bears, 1 pullback, maybe a second leg down. For the bulls, this entire bull flag is disappointing. This was a bull breakout. The bulls are hoping we continue, go for a measured move, maybe pull back briefly, but then continue. But instead, we're going sideways for about 10 bars. And the more bars that get added to this bull flag, the more likely, or the more the probability for a breakout is reduced for the bulls and increased for the bears. At some point, it becomes 50-50. And in this context, we may be high in a trading range. So it actually may be higher for the bears. More sideways on 41, probably sellers above, buyers below. Whenever it's a tight trading range, stop orders will get you chewed up. It's more of a limit order market. And when it's this tight, probably better to step aside and not trade and just wait for the breakout. 42, bear breakout. Looks good for the bears, but all day we've had breakouts that get bad follow through and they fail. It's also interesting what's happening at this point in the day. You may notice ever since bar 6 and bar 19, we've been getting higher lows, we've been getting lower highs. So the range is contracting, and what we're looking at is a big triangle. And this can continue all day. We know it's a trading range day. We're going sideways. Every breakout is failing and reversing. So when you see 42, you can see this bull trend line from 6 to 24. 42 may simply be vacuuming down to that bull trend line, testing support. We're also testing this area. This is an area where traders got trapped. Remember, it was an endless pullback. Bears looking to sell down here for a low 2. Bear breakout, 1, 2. Looking for a second leg. They get trapped. and the bulls get trapped out. And then we come back, retest this price. We're expecting support. So 42 being a strong bear trend bar, traders may wait to see what the follow-through looks like, and if it's disappointing for the bears, then it's likely that bears and bulls will both look to buy. It could also be a second leg trap, maybe a sell-off from here, leg one, or leg one, pullback, leg two. 43 went lower, but it's a doji, closing above its midpoint, and that's disappointing for the bears. The bears wanted a duplicate bar. They wanted 43 to look just like 42, be a bear trend bar closing way down here. But instead, we sold off, tried to break out below the trend line, and then reversed back up. That might be enough for bears to conclude that's two legs down. It's a contracting triangle. We're at support. I'm just going to close my position, buy back my short, look to sell higher. And bulls will also say the bears look like they're failing, maybe a second leg trap, failing to break below the bull trend line. We just had this rally, which was strong enough for a second leg. Was this the second leg? I don't know, maybe. It was sideways. But in trading ranges, you expect deep pullbacks and delayed second legs. So here's a leg, maybe a deep pullback, the bulls buy for a second leg. The reality for 43, it's not a very good buy setup. It's a 4-bar micro channel. 42 is a good looking bar. 43 is minimum follow through. It's probably sellers above 43 for a second leg down. We may test the breakout point, the bar 38 low. Small bull bar 44, not an ideal bar for bears to sell above, but for the bulls, do you think 44 is going to reverse 42? It might. Because we're in a trading range, it's easier to reverse breakouts like this, but if you compare the sizes of the bars, 42 is obviously much bigger and stronger than 44. So there might be sellers above, but because it's a bull bar closing on its high, the sellers may come in at some distance above. Maybe the bears sell a 50% pullback, maybe somewhere up here, or again, maybe they sell the bar 38 breakout point. 45 going a little bit higher, so we're bouncing on the trend line. Traders are paying attention to this line. It's continuing to be support. However, look at the reversal. You can see how the market reversed up here and how it reversed up here. So far, not very strong. It might get stronger. It kind of looks similar to these bars over here. The bulls want to get another maybe pair of consecutive bull bars like this. But for now, not very strong. Looks like a bear flag, maybe breakout, pullback, second leg. 46, we have a bull trend bar. So becoming more like this, where we had some weaker bars and then we start accelerating up. But we're testing an area where traders got trapped. So we still need follow through. We're testing a breakout point. We're testing the moving average. This could be big down, big up. And bears look to sell for a second leg after a delayed deep pullback. So some bears will actually sell the close of 46, scale in higher. Bulls want to argue that the bull trend line is holding. We're starting to get a reversal. They'll buy, front running the breakout, so they'll buy down here, expecting the market will at least come up and test here, if not breakout to the upside. You can see we tested the bear trend line. So from the bar 19 high to the bar 31 high, it's responding to that line. Not a very good sell signal bar. Probably buyers below. We're in the middle of a tight trading range at this point. Stop orders are not ideal. It's a limit order market. Traders are selling high and buying low. We actually still have a lower high here. So high, lower high, lower high, lower high. So the bears will bet we're in an early stage of a bear trend. They'll even sell below this reversal bar. The bulls say this rally was strong enough for a second leg, but it's too weak to buy up here. We're at resistance. They'd rather buy below, and probably not even directly below the bar, but at some distance below, like the bull trend line, or even down below 43. Because even if they bought below 43, it would still be above the bar 24 higher low. However, I'm not sure that bar 24 is a major higher low because it did not break out to a new high. I think the most recent major higher low for the bulls was bar 6, and the market rallied to a new high. And for the bears, they really haven't. It's hard to talk about major lower highs and higher lows in a trading range because these lower highs did not lead to breakouts to new lows. The market's just simply in a trading range. If we get above these lower highs or below these higher lows, there are probably buyers below and sellers above waiting. 48 broke well below the bar 47 low. So any bull who bought below 47 expecting a second leg up, disappointed with their entry bar, they may just look to exit on the close of the bar. This bar went so far below their entry price, they'll be disappointed, probably get a second leg down. 49 pulling back, testing the high close of 47. Again, bulls who bought the close of 47, disappointed by the breakout 48. 49 is a great opportunity to exit that trade at break even, and that's what happened on bar 50. Apex of a triangle, micro double bottom, but bear bars, tight trading range, probably sellers above, buyers below. And then 51 breaking out a little bit more to the downside, still within the tight trading range, but now consecutive bear bars, probably sellers above 51, going a little bit lower. 52 a bear bar, closing on its low, good for the bears, but still within the prior leg, still minor. And the bears might be getting a third push, maybe 1, 2, 3. I'm going to clean up the chart a little bit here. We know it's a contracting triangle. We're paying attention to this point where we're expecting support. This rally was strong enough for a second leg, but bulls know better than to buy at resistance. They'd rather buy at support, like below the breakout down here. So this could simply be a sell vacuum test of support. The market may be selling off here because strong bulls are stepping aside. It may not necessarily be strong bears selling aggressively, especially when you're getting 2 or 3 legs down to the bottom of a trading range. 53 attempted to break out below 43, but then reversed and closed above the breakout point, above its midpoint of the bar. Micro channel, bad signal bar for buying, probably sellers above, and a brief second leg down, but now we're at support, possible wedge, double bottom. The context always trumps the signal bar, so bulls will still buy above 53. 54, we did not trigger the buy, and we have an inside bar. But again, inside bars, when you're expecting trend resumption or reversals, can be good setups. They can be just fine to enter above. In this case, bulls will buy above 54, expecting a rally. And for the bears, they might sell above, betting that the inside bar is a bear flag, bear trend. We're going sideways, sellers above for a second leg down. And from here, I'm going to speed it up a little bit because we know it's a very tight trading range. What that means is it's a limit order market. If I went bar by bar through this, I'd really just be saying probably buyers below, sellers above on every bar. Like here, 55, it's a low 1, but the context is bad. 3 legs down, it's a bull bar, there's buyers below. Then 56 becomes a high 1, or you can call it a high 2, micro double bottom with 53, 56, but it's a bear bar, tight trading range, probably sellers above. In this environment, limit order markets, you can buy below bars, scale in, sell above bars, scale in, and you're probably going to make money. But very tight range through here. Not really worth trading, especially if you are a beginner and if you're focusing on only entering with stop orders. This is not the environment for you. There actually is a decent stop order here on 76, although I usually say at bar 72 to the end of the day, you're getting into the final hour. Not really worth trading at the end of the day. The market can have drastic moves at the end of the day, because in the final hour, the bulls or the bears want to influence what the close of the bar looks like on the daily chart. So it almost becomes like the open, where you can have this huge rally that then reverses, or you can go from a very quiet, tight trading range to a buy the close rally. Anything like that. But at this point, the context made sense to buy here. It's a wedge, 1, 2, 3. And we went sideways for a double bottom with 53 and 76. And here it's 2 legs down, 1 pullback, 2. Or it's even a wedge bottom here. 1, 2, 3. So it made sense to buy here. However, if you're buying on a stop here, what's your premise? We're probably in a trading range. We'll probably test higher in the range. Maybe we'll get a test of the bar 66 high. However, if we do, it's a trading range and 80% of breakouts fail. So we're expecting breakouts to fail. I'll buy above this bar, take profits if we get above this bar. It's a reasonable thing to do. You can see that's what happened. Traders bought. Actually, in this case, this is a good example of a small signal bar where it's really not ideal if you do buy on a stop on 76. The market may have triggered the buy and then went below your signal bar. So if you have a tight stop, it would have trapped you out. But if you had a stop even just 1 times the range of the bar below, your stop would not have been hit. And so you could have bought, you could have even scaled in lower, and then you would have reached your target. And you can see the profit taking on the very next bar. For always in today, it's a trading range day. And I always say for trading ranges, better to think buy low, sell high than thinking in terms of always in. However, if you do think in terms of always in when you're in a trading range, you have to understand that breakouts are minor. You'll probably get brief second legs, but a lot of the times you'll also get deep pullbacks before delayed second legs. And so whenever you see a decent looking breakout like here, it looks like it's always in short, bars 3, 4. But then you go sideways for 3 bars. You might be low in a trading range, and you can easily flip the always in quickly. Then we flip to long on maybe bar 8. But somewhere through here, even though it's a tight channel, the context is still trading range, and we're high in the range. So buy low, sell high. So better to sell up here. So the always in long can fade very quickly, even without warning, like it did here. It might have been always in short at some point during 23, especially on a smaller time frame chart. But for our case on the 5-minute chart, it's really just one big bar down, and it didn't even get follow through. And now you're at the bottom of a trading range. So I'm not so sure that it's always in short on this bar. And I can go back and forth all day repeating myself. Looks like always in long. The bull breakout looks good, but the breakout is testing. It's a breakout point test. We're testing high in a trading range. And so we never broke out above the swing high. You get bad follow through here at the breakout point. We reverse down. We could easily reverse back down. Good looking bear bar, but bad context, back and forth, really throughout the entire day. And we did end up getting a contracting triangle today. And that's breakout mode. So here we are in the daily chart. And then for stop orders today, I thought you could sell below 2, betting on a little bit lower, maybe sell below 3. And then at some point you start going sideways. The premise is no longer valid. You're selling because there's momentum. The momentum dries up. Now you're low in a trading range. 7, a second reversal. You could buy above it, buy above 8, buy above 9. But then at some point, context, not so good for the bulls at the top of a trading range. You can exit below 15, or you can exit below 21 or 20 on 22. You could even sell below 21. I thought it was reasonable. And then second reversal, 27, higher low, double bottom, possible endless pullback. Then you start getting bull bars closing on their highs. But always think back to your premise. You can buy here on a stop, but you're not expecting a bull trend. Aggressive, but you can sell below 31, bear, reversal bar, high in the range. Bears then get an endless pullback, and then their own low 2, below 40. You could sell below here. Betting on a second leg down, testing down at the endless pullback area. And then you're expecting buyers below 43, then you get 54. I thought you could buy above 54, even though you go to micro channel, you're expecting a small second leg, 56, could be that second leg. And then I mentioned this bar, you could buy above it. Thought it was a reasonable stop order. But overall, not really ideal. It's a limit order market. And then for limit orders today, though you could buy below 5, it's a bad low 1, low in a trading range, bull bar. And then on the way up, some bulls will buy below 15, the first pullback, but really not ideal considering the context. 20, it's an inside bar, it's a high 1, late in a rally, consecutive buy climaxes, high end of a trading range. I thought it was reasonable to sell above 20. And then there would have been a low 1 down here on a smaller time frame. It just didn't trigger on this time frame, but you would have traders buying below the low 1 down here. After the bear breakout, you look to the left, low in a trading range, and then you get disappointing follow through 24. So no limit order trade, at least below a bar here. And then what about buying below 31, the first pullback after the rally? Again, it's similar to over here. I really don't endorse buying below 15, even though it's reasonable. And the odds are we're going to get a second leg. You easily could have also sold below 15, used a wide stop, scaled in higher, and then it's almost like you would have been correct, but early. And it's the same concept over here. Bull micro channel, but look to the left. You're high in a trading range. Breakout might look good, but context is more important. Through here, you can sell above bars, buy below bars, tight trading range. Same thing down here, bull breakout, but not ideal to buy here at resistance, better to buy at support down here. So micro double top. Traders could have sold above 49, high 1, bad context, expecting a second leg down. And then through here, I mentioned it's a limit order market with really buyers below any bar, scaling in lower, sellers above any bar, scaling in higher. You're going to do fine. So where do we go tomorrow? Well, this is a contracting triangle. It tells you the market's in breakout mode. The market has been sideways for a lot of bars. We'll probably continue sideways, but when you look at the daily chart, you look at this and you ask yourself, is this a strong rally? Even though maybe you look at a 15-minute chart, we've had a bull channel, spike in channel, bull trend. Look how sideways the market's getting. This is becoming breakout mode. And so with the daily chart context, look at these bars. We rallied, pulled back, rallied, pulled back, rallied a third time. Now we're going sideways. We could have sellers above today's high, and you can argue buyers below, not a very strong sell signal bar. But with the momentum down, the trap traders above, there might be an increased risk. We end up testing lower. Maybe tomorrow or maybe later in the week. But I do think the upside is limited for now. As always, please feel free to leave questions in the comments and include timestamps for any question specific to this video. Alright, hope everyone has a good night. Thanks for watching.